Hey everyone, and welcome to This Explainer. Today, we're going to be diving into a genuinely fascinating concept that pretty much every successful organization has to master, the corporate fortress. We're going to look at exactly how businesses build up these massive, robust defenses against internal threats to protect their hard-earned assets. I mean, think of it like a towering castle, right? But instead of fending off rival armies with catapults, this fortress is designed to protect cash, inventory, and super sensitive data from threats that might be hiding right inside the walls. If you're into structured, efficient learning and really want to understand the architectural blueprints of corporate security step by step, you are in exactly the right place. Now, before we start building those walls, we have to know precisely what we're defending against. And at its core, fraud is really just the falsification of transactions. It's almost never some dramatic Hollywood bank heist. Most of the time, it's just quietly and subtly altering the record of reality to benefit someone illegitimately. Picture this: an employee just slightly bumping up the dollar amount on a totally routine vendor invoice, and then quietly pocketing the difference. Whether it's a forged signature on a physical check or a deliberately manipulated entry in a digital ledger, that falsification, that's the quiet, insidious enemy we're designing our defenses around today. So, here's our roadmap for today. We'll be looking at 1. The fraud management foundation, 2. Who controls the controls, 3. Defending the purchasing process, 4. Stopping computer fraud, 5. The threat of management override, and finally, 6. Segregation of duties. Let's get right into it. Starting off with Section 1, the Fraud Management Foundation. Okay, so a fortress isn't just made of bricks and mortar, right? It's a living, breathing system. A truly effective fraud management program needs 6 very specific components, all working in perfect harmony. You need a company ethics policy to set the ground rules. You've got to have continuous fraud awareness and training. You need to be doing proactive fraud risk assessments, followed by ongoing reviews. And, of course, robust prevention, detection, and investigation mechanisms. Now, why are all 6 of these completely mandatory? Well, imagine a company that drops millions on state-of-the-art prevention software, but they completely skip the awareness training. An entry-level employee might see a massive red flag in a vendor payment, but because they have literally zero training, they don't realize it's a danger, and they don't even know who to report it to. The software totally works, but the human element fails, and the fortress just crumbles. Without all 6 pillars supporting each other, the whole roof caves in. There's a quote from our source material that really hits the nail on the head. Essential elements in preventing fraud are setting the correct tone at the top and instilling a strong ethical culture. This is an absolutely foundational truth. You can build the most advanced, insanely expensive technical controls on the planet, but if the leaders at the top don't act ethically, the whole system just rots from the inside out. Consider a CEO who pushes a really aggressive, cutthroat sales culture where hitting quarterly numbers is demanded at all costs, no matter what. That implicitly tells middle managers that it's perfectly fine to start cooking the books just to hit those unrealistic targets. Controls rely entirely on people, and people rely entirely on the cultures set by their leadership. Moving right along to Section 2, who controls the controls? So who's actually responsible for building and maintaining this whole thing? Well, there's a very distinct separation of responsibilities here. Management, they're the architects and the builders. They are primarily responsible for establishing, designing, and maintaining the controls to prevent and detect fraud. Internal auditors, on the other hand, are kind of like independent building inspectors. They evaluate the adequacy and effectiveness of those controls, they recommend changes, and they raise awareness, but they absolutely do not design the controls themselves. Let's put this into the real world for a second. The chief financial officer, a key part of management, is the one who actually designs the approval workflow for adding new vendors. The internal auditor is the person who comes in, say, 6 months later, to stress test that exact workflow, making sure people actually followed the rules and didn't find some sneaky workaround. Keeping these roles strictly separate ensures that the folks checking the defenses aren't, grading their own homework. Okay, let's dive into this. Section 3, defending the purchasing process. Every single department has its own unique vulnerabilities. In purchasing, the main objective is super clear: proper authorization of purchases. Imagine you've got a rogue purchasing agent working in your IT department. Their day-to-day job is to buy hundreds of monitors and keyboards. Without incredibly tight authorization controls, what's stopping that agent from slipping a top-of-the-line $2,000 OLED flat-screen TV into a massive bulk order and then just quietly taking it home? The controls we put in place are specifically designed to block anyone from treating the corporate bank account like their own personal wallet. We pull that off by severely restricting who can buy and who they can buy from. We're talking strict safeguards like an accounts payable signature authorization list, which basically means only specific vetted people can even initiate or approve a purchase. We also use this brilliantly simple mechanism called a blind copy system in the receiving department. Imagine a delivery truck pulls up to the corporate loading dock with a huge shipment of laptops. The receiving folks know a delivery is coming because they have a purchase order, but the quantities on their copy are completely blank. Because the numbers are hidden, the receiving staff literally has to open the boxes and count every single laptop before signing off. This immediately stops a rogue buyer from ordering 50 laptops, intercepting the delivery, skimming 5 off the top, and letting the other 45 go into inventory unnoticed. It creates this incredibly tight, closed loop of authorization. All right, time to pivot over to the digital realm. Section 4, Stopping Computer Fraud. Just like our physical assets, our digital ones need serious protection. The goal here is to strictly restrict logical access to data files. Picture a worker down on a really noisy factory floor, logging into a basic manufacturing terminal just to check some inventory levels. Even if that worker somehow gets their hands on a valid high-level password for the corporate accounting system, we have a specialized control called a device authorization table that will actively step in and deny them access to the accounts receivable file. The system actually recognizes the physical location of the terminal. Because there's absolutely zero logical business reason for a factory floor machine to access sensitive financial ledgers, the request is instantly blocked. We're essentially building invisible internal firewalls based purely on logic and physical location to stop cross-departmental snooping. But what if someone tries to snatch the data while it's actively moving between those locations? Well, we defend against that by encoding data before transmission. Imagine a salesperson sitting in a crowded local coffee shop using public Wi-Fi to transmit highly confidential client credit card data back to the home server. If a hacker intercepts that data stream mid-flight, encryption ensures they don't get to see names or credit card numbers. Nope. Instead, they just see useless, scrambled, completely unreadable characters. By mathematically scrambling the data, we ensure that even if the walls are breached during transit, the info itself is totally useless to the attacker. And hey, these digital defenses are just as critical when we build or update our internal software. Program changes are a massive and honestly often overlooked risk area. To stop someone from intentionally inserting malicious code, we rely on 4 super strict steps. First, any redesigns only ever happen on a separate working copy, never ever on the live system. Second, a systems analyst acts as a middleman, explaining the business purpose to the programmer. Third, the actual end users are the ones who test the programs, not the programmer who wrote it. And fourth, programmers are completely locked out of operational live processes. Let's look at why that last step is so absolutely vital. It stops the classic salami slicing scheme. Without this separation, a rogue developer could just quietly write a few lines of code into the live payroll system that shaves a tiny fraction of a cent off every employee's paycheck, routing those unnoticeable fractions straight into their own bank account. Locking programmers out of the live operations means no single tech genius can secretly wire the system to pay themselves. Which brings us to perhaps the most dramatic vulnerability of the whole shebang. Section 5, the threat of management override. Think about it. We've built this incredible system. Passwords, authorization tables, signature lists, encryption. But what happens when the very people who design the fortress, the folks who literally hold the master keys, decide they're just going to break the rules? Well, this terrifying scenario is known as management override. It's when management directly circumvents an entity's controls for some illegitimate purpose. Because executives have the absolute highest authority, they're the ones most capable of bypassing all the alarms without anyone even noticing. And why do they do it? It's almost never about a boss stealing petty cash from a register. Far more commonly, it's about artificially manipulating the entire company's financial position. An executive might override controls to make revenue look vastly better than it actually is, deliberately pumping up the stock price just to trigger a massive personal bonus payout for themselves. And these aren't just abstract theories, right? These are very real methods of executive manipulation. Think about a regional manager aggressively approving sales to customers with absolutely terrible credit, purely to temporarily boost quarterly revenue and hit a bonus target, knowing full well those customers are never going to pay the bill. Or consider a corrupt controller who just flat out refuses to close the accounting books at the end of the month, sneaking in an extra 5 days of sales from the next month to manipulate the cutoff. They might alter approved entries to artificially lower expenses. They might quietly change long-standing accounting estimates just to make profits look higher. Or they might start extending vendor payment periods totally against company policy just to hoard cash. In every single case, they're using their supreme authority to falsify the financial reality of the business. So how on earth do we systematically defend against that level of power? Section 6, Segregation of Duties. The ultimate structural defense against human corruption is dividing power. If no single person holds all the keys, it becomes incredibly difficult to pull off a fraud. Setting up a vendor absolutely must be separated from the purchasing function. Contract negotiation has to be separated from budget preparation. Check signers must independently verify product receipt. Let's look really closely at one critical example: keeping employees set up separate from payroll processing. If the exact same person in HR who enters new hires into the system is also the person who clicks the button to run the weekly payroll, well, they could easily create a totally fake ghost employee. They log hours for a person who doesn't even exist and then route those very legitimate-looking paychecks straight into their own bank account. By dividing those two tasks between completely different people, you now require a conspiracy to commit the fraud, which drastically reduces the risk. The whole philosophical point of segregating duties is to minimize the opportunity for any one person to both perpetrate and conceal a fraud. It fundamentally breaks the process into distinct phases: recording the transaction, authorizing the transaction, and taking physical custody of the asset. If an employee actually manages to pull off a theft, but they don't have the authorization or recording power to cover their tracks, they're going to be caught almost immediately. If you can't conceal the crime because someone else holds the next piece of the puzzle, you are far, far less likely to even try it in the first place. It's really a brilliant, natural system of organizational checks and balances. So, we've seen the architectural blueprints of the corporate fortress. We've talked about signature authorization lists, invisible device firewalls, and the absolute crucial need for segregation of duties. But I want to leave you with one final, really provocative thought. A company can build the ultimate system of controls and firewalls, but if the tone at the top is corrupt, is any asset truly safe? Technology and rigorous procedures are amazingly powerful, for sure, but corporate security is, at the end of the day, a deeply human endeavor. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.